All right. Welcome to the Green Margin Podcast, where we talk about the financial and operational realities of running a cannabis business. I'm Daniel Sabet, and today we're digging into a problem that I see all the time. Operators who look profitable on paper, but are still very much stressed about cash. This episode is really about understanding the difference between revenue, profit, and cash, and why confusing those three can quietly stall your growth. Joining me today is Val from GreenGrowth CPAs. Val works closely with cannabis operators all across America around inventory, margins, and most importantly, cash discipline. And she sees firsthand where businesses get stuck and how they get unstuck. Val, thanks for being here today.
Thank you for having me, Danielle. I'm excited to be here and start our very first episode. I am a senior accounting and finance manager at GreenGrowth, and my job is to work closely with cannabis operators and provide insights on their finances and their financial performance. So the issue that Danielle is bringing today is it affects all the operators, and I encounter it quite often when I am on a meeting with the client and I go over income statement and the margins look healthy and they have some income. Sometimes they might wonder why then they don't have cash in their account, or why they need to put in more money, why they cannot take out money yet, especially when the business starts. And this is where we run into that issue, right? The classic set of the financials is the balance sheet, income statement, and statement of cash flows, right? And often business owners would focus on the income statement, and this is what their primary goal. They understand it well, right? Here is my revenues, here is my expenses, and this is my income. Sounds very straightforward. But then when you compare it to the changes on the balance sheet, this is where all these additional money in and money come out are, right? Where we want to pay close attention to.
Yeah, no, I hear you. I've spoken to so many different operators, and like you said, they look at the income statement, they say, hey, look, this is my top line, these are my costs, this is my bottom line. My net income is X amount. Where is that money? Why is it not in my bank account? And yeah, it sounds like you have the same disconnect. And where do you think these things usually start to break down?
I think that what I would usually do if we look at the, let's say, statement of cash flows, or we look balance sheet month over month, this is where we see those hidden expenditures that you won't be able to see on the income statement. This is why it makes things confusing. With the balance sheet, the way how it works, that assets always equal liabilities plus equity. So what happens is that if you invest in, let's say, equipment or any other fixed assets, if you bought more inventory this month, if you collected less cash from your customers, or if you paid more bills or paid out dividends, or the partners did withdrawals, this all depletes your cash, but then those are not visible on the income statement. So there is no way to tell what happened to cash by just looking at the income statement.
That makes sense to me. And it sounds like whenever you discuss this with clients, obviously you'll go over the income statement with them, which is great. And it's important knowledge for them. But then the other financial statements, one particular being the statement of cash flows, I think that would show the ins and outs of the money and how certain items on the balance sheet, certain items on the P&L can affect the cash flow up or down, and ways to mitigate against that. Is that something that you encounter quite a bit?
There are, with the cash flows, you can look at direct or indirect method, and I think that this indirect method, it's first of all, it's more widely available with the basic accounting software like QuickBooks, Xero. If you go to the statement of cash flows, it would usually offer you indirect statement of cash flows, where it starts with net income, and then it shows what are the changes in operating, financing, and investing cash flows, right, that you have, what happens there. And this is where pretty much what business operators say when they're meaning making money is just only the very top of this indirect method, where it starts with the net income, and then we'll go over all the changes that happened to that made money, so it translates into change in the cash position at the end of the period.
It sounds good. Yeah, and it sounds like some of that money spent would eventually get expensed in certain categories, but that's where the depreciation comes in, right? It gets expensed over time, not right away. So your money's kind of stuck there, not getting those deductions in the meantime. And then it also sounds like there are some funds, which we'll get to in some of our later questions, but it sounds like there are certain things that are purchased and money hasn't been collected yet, but because everything's on a accrual basis, so that income is accounted for, but cash has not come in to reflect that.
Clear.
Very good. Yeah, because I get a lot of clients, and here's a question I have for you, and more pertaining to payroll, because I have a lot of clients who come to me, they say, hey, we're making money, but every Friday we're stressed about payroll. We don't know if we're going to be able to make it or not. That's mind-boggling to me that in their mind, they think they're profitable, and maybe they are profitable on paper, but then when it's time to pay their employees or pay their contractors, they're always scrapping for cash to pay them, and they have to delay it in some cases. What usually happens behind the scenes in those situations? Like what's going on that's causing all that?
I would say that usually happens when the business operators don't look at their financial statements that often, or maybe they are not projecting their cash flows. And nobody should go through that, right? Not being able to pay payroll. And suddenly nobody needs to do this to themselves. And so what I would usually tell them to do is just start with some cash forecast, usually in our standard cash forecast would be a 13-week cash forecast, right? And here you would pretty much lay out all the expenditures, and you would start with the bare necessities, and maybe it's your inventory, payroll, rents, things that you cannot afford not to pay those things. And then you will go with more conservative projections for the income that is coming in. And this is where you see, oh, this is what is left, and this is what I can spend on other things. So really, I think that it's not only helpful for those businesses who struggle with cash, but also for the profitable businesses who have cash, but then they are worried that if they're gonna take out money, they not gonna be able to meet their other obligations, and that make them stressed. So anyways, sometimes I think that people feel very stressed to look at their financials, so they avoid doing this altogether. But the uncertainty of not knowing what is going on in your finances makes you even more stressed afterwards. So it's always good to have a very proactive approach and really keep attention to those things, right? Because it doesn't have to be this way. We have people who would take out money and pay themselves wages, and then they don't have money for anything else. And then we have opposite side, right? Where people are so worried to take out any wages for themselves because they are worried that they might need to pay something and they might not have cash. So they tend to accumulate more cash than needed.
Yeah, I couldn't agree more. I think it's beyond even stress. I think it handicaps them. Like they're handicapped to the point where they get brain fog. They can't make good business decisions because the whole time they're just like, what do I do with my cash? Do I have enough? Oh, let's get money from Peter to pay Paul. Let's do whatever we got to do. Let's scrap away. But you make a great point. This 13-week cash flow, you'll put your fixed costs in there, right? You know what your rent's going to be every month. If you have a certain subscription cost, what it's going to be. And then the variable costs are like the other things. And I'm about to jump into the inventory. That's more of a variable cost, right? Because it's really important for you to understand how much inventory you need to buy at any given point. Because inventory, from what it sounds like, it's not a profit and loss item. It's a balance sheet item, and it only gets put into the profit and loss once the actual specific product is sold. And inventory overall, it feels like an asset, but it quietly eats up the cash. What have you seen with inventory? What's like the danger zone in cannabis? I feel like people just tend to buy too much and they don't need it at that point, and then they're just like figuring it out on the go.
Yeah, I would say that managing inventory, especially for when we talk about these dispensaries, is cornerstone of success. So what I see a really successful operator would do, they usually have subscriptions that are doing some marketing research on what products sell the best, and they're making sure that they stock their dispensaries with those hot products that can sell in couple days, right? And sometimes we will see the operators who would be stuck with a very slow inventory. And I think that what then hurts them is that they feel that they cannot afford selling those items at discounts, and they still hoping to get margin out of it. And so what happens is that this inventory that won't sell just sits on a shelf for months and months. And so if you think about it, this time where this inventory sits and it holds your cash, it costs you more money down the road. So let's say even if you take this inventory and even if you sell it lower than cost, even you free up cash, then you can go and buy more hot inventory and you can turn this around multiple times a month compared to if you just have this inventory that won't sell. And so I invite the operators to be more open-minded about just not getting too attached to those inventory items. I know that you paid money for it and it has value to it, but sometimes it's just better to let it go and just open your shelves for something new.
Yeah, no, I hear you. A funny thing about that, I had a client recently in a retail store, and as I was inspecting their inventory, I noticed that they were buying quite a bit from one particular vendor, like probably three times what they needed. And I asked them, I'm like, hey, why are you buying so much from them? And their response to me was that they're giving me a discount. They give me a 5% discount if I buy this much versus if I was to buy one third less, I wouldn't get that 5% discount. And that was mind-boggling to me because they in their mind they feel like they're getting this 5% discount against their cost of goods, but then what's going to happen is that inventory is going to sit on their shelf, it's going to age, and then in an effort to get rid of it, they're going to have to discount it probably 20 to 25% more than what they wanted to. So ultimately they're losing, whereas if they had just the right amount of inventory and they're just rolling it over each and every time and also testing out the brands, they'll see they won't have to discount those. They won't be like highly aged items. So it's just, I guess it's more of a mindset thing, right? Where it's, oh, they think so much about saving the pennies, but they're not looking at the big picture of like down the road how much it's really going to cost them.
And if you think about it, even if you take this money and just put it into savings account, you're probably gonna earn 5% on it compared to the inventory that just sits there and not and brought you a discount.
Yeah. Yeah, it's fool's gold, it sounds like. Yeah. And what is the typical, from your opinion, from working with all these different operators, like how fast should inventory churn within the shop where they go buy more?
So usually I would say that it depends on the type of the product, right? So we see that there will be different requirements for the inventory that has expiration. And then there is some inventory that maybe they have longer shelf life. And then there are just things that tend to sell slower. So usually the hot selling product is flour. And so this is where we want to see like really hot sales that like just flying off the shelves and you need to replenish all the time. If flour sits and doesn't sell, I would say that this is the concern. Accessories, for example, can take really a while to sell, but usually people we would, for example, stock limited accessory units and it sells pretty much when it sells. So there is no like less pressure on those. But for those items that needs to stay fresh and be of high quality, we want to make sure that they sell fast and that you are getting the fresh product from the vendor.
That's an interesting take. And I've actually seen that take on other industries as well. I had a friend who used to work at a car dealership, and I remember I think it was BMW, and there was a specific model of that BMW that they made a lot of. I think it was the 3 Series, and they would make so many of them, and they would just get them off the shelf quickly. They would even give good lease deals on them. But then when it came to the specific SUVs, they only had a few of those on inventory, and there was no negotiation at all on those. And I would always ask him, hey, if you're giving such a great deal on these, why not on the SUV? And he's, listen, we only have 5 or 6 of those on the shelf. Somebody who really wants an SUV is going to come here and they're going to pay top dollar for that. It's not like a widget like the other one. I guess in this particular case, what you're talking about, flowers like that, right? It's just like it's the most popular item. It comes and goes quickly. It's in the best interest of the shop to get it off the shelf quickly as you can and just keep buying more.
Yeah, I would say that if it takes months to sell flour, I would be really concerned about that, and I would be looking into that. It
Yeah,
should.
that's what I've heard too. I think it's like they say 30 days is good. If it's more than that, like try to get it off by 60. If it's more than that, then you're just like you're in bad shape. You gotta really discount to get it off because and that's
Yeah.
not a good sign. Yeah. And I guess you just got to manage inventory right because I've had some other operators who say we didn't buy enough inventory. And then as a result, when people come and they see our shelves are empty, it's just a bad look. People like, what is this place? It looks like a half-run store. People like to have like well-selected options, right? You look up and you see all these great options and you have something to choose from. But again, it's all about managing that, right? You buy just the right amount, you keep your cash flow strong, and then you can reinvest the money in other things.
Yeah, exactly. Sometimes, for example, when we look at the balance sheet, your inventory looks great, but then we look at the composition of that inventory, and then it turns out that hot inventory is out of stock, and then low selling inventory is too much of that, right? And so it creates this unhealthy balance where we are having this discussion. Let's recalibrate your inventory, right? Let's sell out all the slow moving inventory. Let's invest more in hot inventory to make sure that your shelves are stocked with the best product that the people are gonna buy.
Yep. Now, Val, one thing I want to talk to you about, let's jump over to some of the wholesale aspects of cannabis, because I have a lot of clients who they sell, they cultivate, they sell their flower, and they have terms with their vendors. And a lot of times they don't get paid on time, or a lot of times the people who they're selling to are not profitable, and then they end up having to delay their payment terms and go out of business eventually. And it just becomes a big headache. And so I guess just talk to me about how that affects their P&L, because these invoiced amounts, right? They're recording those as sales, they're hitting the P&L, but they haven't technically collected the cash. And I guess how important is that AR function, that position of being there to enforce the collections?
Yeah, I think that it's been especially painful in California market with we know that in California we have a very large tax burden and dispensaries, a lot of dispensaries have thin margins. And so what often happens is that less successful dispensaries unfortunately will default on their obligations to the vendors. And now the vendors are in a situation where they technically look good and profitable on the income statement, but then they are unfortunately not able to collect this cash. And so we have the situation where the cultivation business, good on paper, but can like really struggle in real life. So with that, and especially when it comes to the periods where there is oversupply, I think that they tend to be a little bit more desperate to sell out their stock, and they would provide the stock to a lot of dispensaries where they don't really know what is the financial standing of that dispensary, and then they would just lose money on that. So really being mindful on if we provide payment terms, who we provide them to, and would it hurt that much if we require cash on delivery, right? And maybe we can require deposits from the new dispensaries, or maybe dispensaries we don't feel comfortable with, right? And only the trusted dispensaries who've been working with for a long time. Then we can provide some, for example, net 30, and just really be mindful about how much we sell this dispensary and how I think that analyzing accounts receivable, right? How long it takes for the dispensary to pay money. Are they often delaying their payments? You need to be very mindful about those red flags, right? So if the dispensary is behind on those payments, you probably need to stop supplying them, right? And see, are there any options to maybe do less deliveries and more collections? Because we have a lot of issues with that, just collecting the cash.
Absolutely. Yeah, it's all about the leverage there as well, right? It's like how much are you going to work with them? In some cases, if they're behind once or twice and you want to work with them, you want to show that you're a good business partner, you might say, okay, you know what, it's fine. We can push this along. But if it's a consistent practice, I've always been told this, you know, the saying, fool me once, shame on you, fool me twice, shame on me. If it's a consistent practice where you're constantly delaying payments and just the balance keeps getting bigger and bigger, chances are you're probably never going to collect it, or a large chunk of it at least. So that's where you got to just walk away from it and just stop working with them until they start paying you. And then if they don't end up paying you, whether you want to take legal action or not, that's up to you. Legal action obviously has its pros and cons, but willing to walk away from a smaller amount rather than letting it build up to that point. And I guess just happens, I feel like a lot of these people, they don't even have a strong AR person in-house who reaches out to them and collects it when it's due. It's like they just assume, okay, we have net 30 days, they're going to pay me, but then they lose track of it. And then all of a sudden these balances just get bigger and bigger. Have you had like some of the good operators that you work with, do you feel like they have that strong AR function?
I would say usually they would have the salespeople who are very well connected with those dispensaries. And I think that sometimes it takes an effort to collect that money. So I used to work in the accounts payable department, and I gonna tell you the truth. Not the nicest people are getting paid first. So usually we had those very aggressive vendors who just May 1st, you owe us for April, and they will just call us 8 a.m. May 1st, and we were always making sure that they are getting paid, because otherwise they're just gonna not gonna let us like alone. And so pretty much the most aggressive ones being paid first. And so usually building this relationship, staying in touch, following up regularly, it just does magic.
Yeah, it sounds like the mafia mentality, right? The more threatening you are about it, the better chance you'll get paid up front. Excellent point there. All right, yeah. And then I guess as far as the P&L goes, if this money is not collected, it should at some point reflect on the P&L, but it just wouldn't be at the same time, correct? It might go on to the following year, the year after as a bad debt expense.
Yeah, technically, if we follow GAAP, right, so we need to project some bad debt and we need to have some allowance for the bad debt every month. But usually with small operators, that doesn't happen. So usually we would wait a long time before we even write it off. So usually you wouldn't be able to see it on the income statement. So what happens usually is that I would talk to the clients and I will tell, you have this taxable income. If you would like to reduce the taxable income, we need to really remove the uncollectible invoices, right? Because we don't want to pay tax on something that we know that we're not going to collect. And this is where we start reviewing everything, writing everything off, and then we are hit with quite a large expense. And then we don't want to see it in the current period. So we'll usually push it back to last year because so we can see the healthier, let's say, income. But we cannot deny the fact that we have this bad debt and it's a
Yeah.
big issue.
Yeah, it sounds like it's just got to be the reasonable time of uncollectability, right? If it's the time that you realize that you're not going to collect it. Some people hold out hope and say, "Oh no, they're working on it. They're gonna raise some money. They have a new investor coming in, and once they get that money, they're gonna pay all their obligations, including ours."
When we start working with the client, I usually see invoices as old as 2 or 3 years. And I think that sometimes the operators won't even write them off. So it can always look like it was earned until you have this conversation with maybe your financial advisor or your accountant where they're saying, hey, we need to remove it because your balance sheet doesn't look good now. Too much accounts receivable that are uncollectible.
Yep. Yeah, all valid points there. And Val, I know you work with a lot of clients with tax estimates, especially on a quarterly basis. And that's something that I feel like a lot of people fall behind the eight ball on that, right? They don't put money aside for taxes. They don't know how much they're going to have to pay. And especially with the whole 280E aspect of cannabis, they need to know what's that right number to use when calculating the taxable income. How have you seen that just cripple businesses in general?
It's I think that we have much more operators that are behind on their tax payments that we wish, right? Because what happens is that, especially 280E, right, it's really tricky because what happens is that sometimes an operator might operate at a loss and they would expect they won't have tax obligations at the end of the year. But then when you apply 280E and you are required to pay a tax on your gross margin, this is where it hurts and you might have to pay some tax even if you didn't make money, which is pretty much you pay tax on this ghost income. With that, if the operator is not proactively working on setting money aside throughout the year, they might be in a situation where now they need to come up with a lot of money to pay. So in April, we'll have the situation where we filed our tax returns. Now we are due taxes for 2025. But then in April, we also have to make Q1 estimated tax payment and then continue making those every quarter. How we gonna go about that? So usually we would help operators estimate what needs to be set aside. And of course, sometimes they might prefer to have less cash, or if they have a lot of need, for example, to pay payroll or to pay inventory, they might not be able to set that required money aside. But this is something to keep in mind, right? When you have funds available before, oh, this is free cash that I can take out of the business without hurting any expenditure plans. You always need to make sure that you remember to say that those income taxes are coming to you.
Yeah, I couldn't agree more. And I feel like there's a lot of nuances with taxes. People have misconceptions about how it works. I'll just give you a few examples of what I've seen. I've seen some operators who one year they have a big loss and they assume that entire loss will just offset the income for the next year. But I know, for example, with C Corps, that there's a cap on that, right? It's up to 80% of the amount would be attributed to that loss, and the rest you got to pay taxes on. Also, with certain states, I know California, even if you do have a loss, there is this concept of alternative minimum tax where you're still gonna have to pay something, and you need to account for that. And then a lot of times they don't realize that they took huge amounts of depreciation from the prior year. but that depreciation didn't necessarily go to the state. The state has different depreciation rules than the federal. So you might take a huge bonus depreciation of, let's say, I know with the Big Beautiful Bill for 25, they're taking 100% depreciation on federal, but then on the state side, it's just based on the useful life of the asset. So now it's, these guys had $4 million of depreciation bonused out, but then they're only getting 1/15 of that on the state side, or 1/7 of that, depending on what they're purchasing.
There is a lot of nuance to it, and it's not just pay whatever you paid last year, right? And you're gonna be fine. So it's always the best to work with the tax professional and have them do some tax planning. And even in general, right? We want to usually there are some tax strategies available how we can reduce this tax obligation, but a lot of them just need to be implemented proactively and cannot be done post factum. So it's always, if you know that you're going to be running into a large obligation, reach out to your tax pro and say what can be done, so we can definitely look into all the different options that are available.
Absolutely. And I think with you and your clients, you're meeting with them very consistently. Usually it's monthly or quarterly. So you can address these issues as they come up. It's not like after the fact, like, oh, by the way, you owe all this money in taxes. It's, hey, you got to set aside this money for this quarter. These are the implications. The state side's going to be a little different. Now they have better management and control over the whole situation.
Yeah, absolutely. We are staying up to date with that, and we sync up regularly to see what their plans are and if there are any changes to make sure that our tax plan is always the most relevant to them. And then we see other thing when a new client comes in, right? And we see all the historical things and how they are now hit with the large tax bill because they didn't take some proactive measures back then. And we are not time travelers, so it's always better to see the clients they're just starting, and you can build some strategy from before they need it, let's say.
Exactly. Okay. The last subject I want to get into is owner distributions. And obviously, there's different types of entities. So the term distribution could just mean owner payments, right? Owners have a business, they want to get paid somehow. And I think what a lot of operators don't understand is that, especially those first couple of years, the amount of distributions you should be taking are very minimal because you want to reinvest money into the business. And a lot of times they look at their P&L, they see they have profit, and they're like, okay, let's take some money out. And then with all these other things that we talked about, with the inventory, with the taxes they got to put aside, all that stuff, they might over distribute, take too much money out in the first year, and then they don't have money to pay those obligations or to expand or grow the way they want. So why is this such a hard conversation for the owners?
There are different nuances to that, right? I heard that there is even this philosophy where people are encouraged you should be getting paid first, and then figure out how to manage the business with the amount that is left, right? And of course, sometimes people also have the financial needs where they need to support their families and they need that money, right? And so you can see those payments coming out. And again, right, this comes down to really, in this case, if we are talking about a couple years upfront, I would also say, in addition to this 30-week forecast that we have, right, it's good to have budget as well. So if you plan in any expansions, it's good to include them in the budget as well. Then you can see clearly how much you can afford. And especially when multiple partners are involved, it might be a hard conversation because it's not only one person, but it might be also some, let's say, silent partners who invested money and they're expecting a return. And then when you cannot afford to pay this return, this is where it can kill the business. And then you would need to have these difficult conversations where they might be underpaid just for the sake of the saving business. Because what we don't really want to happen is that you need money yesterday, you already have a lot of liabilities, and now you're looking into financing. So pretty much you put yourself in a situation where you have very little leverage. And usually we see people starting taking on very disadvantaged loans at high interest rates. And if a business ends up paying in interest expense more than their net income, we'll see how it's like a death sentence for the business. So you definitely, if there is possibility that you might need additional cash in the future, you really need to know this at least 6 months before it happens. So it shouldn't happen to you that you don't know how to pay payroll on Friday, right? So you need to be like really looking into those things and pay attention.
Yeah, no, I couldn't agree more. And one funny thing about it is when the entities are a flow through, let's say, it's a double whammy because now not only are some of these partners not getting paid, but they're now getting hit with a tax bill personally. So I think in those cases, it's really important to at least distribute the right amounts that are comparable to them paying their taxes at a minimum, it sounds like. Because otherwise they're putting all this money in, they're not getting any of it right now, and the entity's making income, and then they're paying taxes on phantom income that they haven't received any cash for.
Yeah, that's a tough situation, and that's why usually what we recommend, if that's just an investor who cares more about their rate of return rather than the success of the business, it's probably a better idea to organize a C Corp. In this way, at least when the money comes in, and if they're not getting anything out of it, they're not hit with the tax, right? C Corps are really a good tool to reinvest and expand, because if you are not paying out dividend, then you're not paying taxes personally, and then you can grow this big corporation, you can do a lot of expansions, and then you can also benefit of this capital gain exclusion, where you can even have a very beneficial exit right at the end.
Very good. All right. Revenue is vanity and profit is performance. Cash is survival. Val, thank you so much for joining me. And to everyone listening, thanks for tuning in to the Green Margin Podcast. We'll see you next time.
Thank you, Danielle.
Thank you.